Hey guys, buying LEAPS versus owning 100 shares of the underlying. Which is best? I'm Andre from the trading crew, and on this channel we break down stocks I love, stocks you love, and stocks nobody should love. So I'm not gonna get too in depth in this video on what LEAPS actually are. I definitely, or actually is, it's one thing, not plural, although it's called LEAPS. So it stands for Long Equity Anticipation Securities. It's an options play, and it's one of my favorite strategies that we can use. So what it actually does is it allows you to control 100 or almost 100, depending on the delta that you have, shares of one specific underlying stock without having to pay as much for owning those shares. So in this case, I do not want to have this be a tutorial on what LEAPS are. I do have a favorite one out there though, so if you go ahead and search on YouTube for the In the Money LEAPS tutorial, the guy really did a fantastic job on that, so head on over and have a look at that. I'm not sure if I'm ever gonna upload a video about what LEAPS are. I do want to have a look here at an example of going head-to-head between a LEAPS and 100 shares of the same underlying. And actually what we're gonna do here is we're gonna build out a series of videos on how the performances on each of these is going to go within the next few months or maybe even year here. I'm not quite sure how long I plan on holding either of these, but I do want to talk about it. So without further ado, let's have a look at what I actually did. So a few days ago, I ended up opening up a LEAPS position on CCL. This is Carnival Cruise. Carnival Cruise is one of my favorite stocks nowadays because it's such a powerful potential reopening play, with all of the cruise line companies out there really being hit hard by the pandemic and never having recovered yet since being really hit by COVID. So with that in mind, I opened up a LEAPS on CCL. It cost me right around $671 to open up that one position that you can have a look at here. So as you guys can see, this is made out of two, and I'm going to go into detail on why that is. The first one that I want to have a look at here is the $30 strike price call that I have bought for $6.71. Again, this is per share, so since this represents 100 shares, it's $671. This one expires in September 16th 2022. So for all intensive purposes, we have more than a year and a half before this one is gonna expire, or actually less than a year and a half, a year and right around 3 months from now. At the same time, I also went ahead and sold the call against it. And you guys might have heard about this strategy as being called the poor man's covered call, because it allows you to sell a call without actually owning 100 shares of an underlying. So in this case, we have sold a call on CCL here that expires on July 16th. So in just over a month here, right around 31 days. And what this helps us do is we collected collateral of 56 cents times 100 shares. That's $56. So we ended up being able to purchase into this position for $615, and now we own the LEAPS that is gonna expire in September 2022. So with that in mind, what's the plan here? The plan is gonna be to continue selling covered calls on this one position until it makes sense for us to get out of the position. So if CCL say it absolutely moons a few weeks or months from now, I'm definitely going to close my position. But if it doesn't, if it keeps on going higher and higher at a steady pace, I plan on keeping to sell short calls on it, so covered calls on it, so that I can get the average price that I paid for this LEAPS position down. As you guys can see, I've already reduced $56 from it, so it now costs $6.15, but I plan on reducing additional $50 to $70 from it every single 30-day period from now up until right around maybe July of 2022, because I don't plan on necessarily exiting this position sooner than that, especially if CCL doesn't moon. So this will eventually allow me to potentially make, let's say, 10, to keep the calculus simple, let's say 10 times 50 here, that's 500. So potentially I can end up owning this one LEAPS for as little as $115 come August, basically, really close to the expiration date of this September 16 one. And then obviously that's gonna allow you to make a killing on it from the upside of the LEAPS itself. Cool. So with that said, let's have a look here at the same thing but with shares. I basically bought 100 shares of CCL. They cost $28.71, and the plan here is to sell covered calls on CCL as well. So actually this is something that I've already done, as you can see here on the screen, and this helped me also get my average cost per share down for CCL, and I continue planning on doing the same for as long as it takes until I get assigned. In this case, I expect to get assigned within the next maybe month or 2 months, so I'm not really bothered by it. And in case CCL pulls back, I definitely have a hedge against it, because I'm able to sell these calls, which are actually gonna make me money if CCL is going lower here. So that's why I really love the covered call strategy here. I feel like this is one of the best strategies that you can use in the stock market. So with that being said, guys, this is the first episode of the series. I'm gonna keep you posted on both of these. I'm gonna send out frequent updates with regards to how exactly both of them have been progressing and what sort of money are we making on either of these. And definitely stay tuned. If you're tuning in on this video a few weeks or months from now, you're gonna probably be able to already see a few of these videos. But if you aren't, please remember to subscribe so that you can see the updates after this one. And obviously, if you enjoy the content, hit that like button, and I really appreciate you spending your time having a look at this video. So I'll see you around next time. Take care.